Ladies and gentlemen, welcome to the Plain Bagel. I'm your host, Richard Coffin. As you might have heard, meme stocks are back in the news, with companies like GameStop seemingly having awoken from their slumber and seeing a remarkable 2 days of performance, with GameStop specifically seeing intraday jumps of over 100% on both Monday and Tuesday before settling lower, with the stock ultimately up roughly 180% from Friday to Tuesday close, and a number of other meme stocks seeing a surge, such as AMC, which itself jumped as high as 300% before settling up roughly 100% over that same period. And as for what's causing this groundbreaking, remarkable performance, a guy posted this picture on X. That's it. You see, this was specifically seen as a comeback post by Keith Gill, also known as Roaring Kitty or Deep Value on Reddit, who you might know was effectively the poster boy of the original GameStop rally. He was the one who posted his thesis online about the company and how he thought it was undervalued and made off with a bunch of money as the stock saw a historic run. But ever since that initial rally, a lot of meme stocks have lost most of their steam, with many losing the majority of their gained ground, and Keith Gill, for his part, having really fallen off the radar, having not really posted since mid-2021 and since his testimony in the congressional hearing around the GameStop debacle. That is, however, until Sunday, when Keith Gill posted on his X account, again, this picture, which many interpreted as him saying, "Time to get serious." And since then, he's actually been posting a number of cryptic movie montages and things of that sort, all with the motifs of revenge, comebacks, the return of a warrior, those kind of things. With this seemingly being successful in rallying people to GameStop, with even a number of big names hopping behind the company. One of the more controversial being Andrew Tate, who has fully thrown his weight behind the position, even changing his X bio to now read "Buy GameStop" and the Matrix. A bunch of other popular X accounts have likewise been going full speed ahead trying to promote this rally. And even Vlad Tenev, the CEO of Robinhood, has made posts referencing Keith Gill's return. And with us seeing this deja vu around meme stock rallies, a bunch of people promoting it, and influencers really tying themselves to the movement, I have once again been summoned to strike a more cautious tone. And to be clear, none of this is to recommend a buy or sell for the position. I have no predictive power over where the stock price is going to go in the short term, since a lot of it at this point is really just human behavior, which is incredibly volatile at times. But I do want to provide some context around the rally to explain what we've seen so far, and to really tackle some of the more speculative theories about whether this is, for example, the mother of all short squeezes and theories of that sort. But let's start off by explaining a bit more information about what's happened. As mentioned, most of this seemingly began when Roaring Kitty tweeted out that picture, which again, many saw as a comeback of someone who might start, again, throwing their weight behind GameStop, or perhaps posting some theories about the stock, or might have some secret information about the position that no one's aware of that might, again, cause it to skyrocket. And so people tried to get ahead of the curve. With the stock experiencing a level of volume, or how often the stock actually trades hands, not really seen since the initial rally in early 2021. In fact, there was so much volatility for the stock price, it actually prompted exchanges to halt trading on the position a number of times on both Monday and Tuesday, with GameStop specifically being halted 9 times in just over an hour on Monday, with even a number of brokers appearing to have outages when clients were trying to purchase GameStop, with E-Trade and Robinhood specifically coming up as examples where some clients were experiencing troubles, and even ComputerShare, which is a common platform or service rather for direct registration, experiencing an outage on Monday, which some did view as awfully suspicious given with the last GameStop rally, all the allegations around Robinhood colluding with hedge funds to effectively freeze buying on GameStop in late January of 2021, which ultimately led to the end of the rally. But with NASDAQ, it's worth highlighting that these exchanges often do have predetermined volatility triggers to lead to halting of trading just to let things cool down. And with brokers, as with the first time around, we did see a lot of technical issues arise when these brokers were hit with massive unexpected volume for GameStop back in January 2021. So we'll have to wait for more details around that. It's again not unprecedented that a surge in volume could cause problems at the brokerage level. And as mentioned, it wasn't just GameStop who rose on Monday. We also saw AMC, BlackBerry, as well as a number of other, again, generally considered meme stocks jumping as people saw this return of this sort of retail investor movement. With this all leading to hedge funds allegedly losing roughly $1 billion on Monday alone, something we could expect to see repeated for Tuesday, as funds who bet against the company naturally take a hit. With this again leading to that theory that retail investors might be able to trigger a short squeeze here, which as a quick refresher is when a given stock rises so much in value that it forces people who are short on the position or betting against it to exit their short, whether it be because they try to cut their losses or they're actually forced to with something like a margin call. And to exit a short position, you actually have to buy the stock back, and that buying pressure pushes the stock price even higher, leading to this positive feedback loop of stock goes up, short sellers have to exit, stock goes up. And even after the initial rally in 2021, there were a lot of adamant supporters of GameStop and many other companies who argued that we haven't seen the, again, mother of all short squeezes yet. This sort of mythical event when all the people who are short on the position will be squeezed out of the stock, which will cause it to skyrocket beyond what we've ever seen before. And we will jump more into that, but before hopping into the more technical trading aspects of this play people are trying to carry out, I do want to quickly touch on the fundamentals of the company, because ultimately over the long term, it tends to be the fundamentals of a business that drives its stock price, with obviously exceptions for events like this. And while the company has changed from its rally in 2021, it's still worth highlighting that the company is not doing overly well at this point. The initial rally did actually help the company improve its balance sheet by virtually paying off all of its debt and sitting on a healthy cash balance of roughly $3 per share. But the business has been losing money. They've been struggling to generate positive operating cash flow. And really the only reason, again, they were able to pay down that debt is because they actually raised $1.7 billion from investors when their stock price had seen this rally. And while the company has promised changes around its business strategy and a movement away from selling physical game copies and things like that, we haven't yet seen that turnaround. Revenue since the initial rally is down roughly 12.3%. And their profit margin, while having turned positive recently, is still 0.3% for the last fiscal year, which just recently ended. And unless we see a significant change in what this company actually does, it's questionable how much room there is to expand its profit margins. Roughly 75% of their costs are associated just to the cost of goods sold or the cost of revenue, whereas 25% is related to sales, general, and administrative, which, given that they're a retailer, is hard to cut down without actually reducing their sales. Now, of course, there's always a chance that the company is able to change itself, and you could see a revolutionary shift. Say if they use all their money to acquire a completely different business and just change what they do. But it is worth highlighting that consensus estimates for their earnings in 2026 is currently at 7 cents, which you do have to take with a grain of salt, given how often this changes and the fact that no one can predict how GameStop will perform. But if you take this at face value, it does mean that at a $51 stock price, the company was trading at a 2026 price to earnings ratio of over 700 times. And even if the company were able to keep revenues flat at their current level and, say, increase their profit margin to the highest level they've ever seen at 5% in 2017, their EPS would still only be 86 cents, which would put them at a relative valuation of 60 times, which would be roughly double the valuation ratio of companies like Microsoft. So again, it's not to say that the company can't experience a turnaround, but it is to highlight that there is a pretty big gap between what the company is trading for and where they are today. And it would require quite significant improvement from where they are to close that gap and justify where the stock is currently trading, which is why you see people saying that the stock has departed from its fundamentals. But of course, a lot of people aren't buying GameStop here because they think it's an amazing business or that it's going to be profitable next year or whatever have you. They're buying it for that more technical trading aspect, the potential short squeeze or just momentum around the stock, the fact that the stock price has gone up. Now, especially when it comes to short-term price movements, I have no predictive power over where the stock will go. It could be 3 times what it was when I started filming. But it is worth highlighting a few things to kind of tackle some of the more popular speculative theories about what's going to happen with this stock. With the first one being that even though there is still short interest in the position, generally it's a lot less than what it was in early 2021, which reduces the likely impact of a potential short squeeze. Short interest by some estimates currently sits at 24%. And as high as 50% for off-exchange shorting volume, meaning that's effectively the share of the company's stock float that short sellers are betting against. And while certainly relatively high when compared to companies like Microsoft, that 24% is a far cry from its high of over 100% during the initial rally. And that's in part because, as highlighted by an SEC investigation following the GameStop rally, a lot of short sellers may have effectively been scared off of this position given the increased risk and cost of shorting such a volatile position. While there's often this idea that hedge funds are really holding on to fight this battle and crush investors who want GameStop to succeed, it's more likely that those who were burned and perhaps saw a big drop in capital are just not interested in touching the stock anymore. Now here it's worth highlighting that short interest is an incredibly crude estimate. It's not reflective of all the short selling activity. We could see a much, much higher short interest here, especially when you consider that ETFs such as XRT, which includes GameStop, has a ridiculously high short interest. But there we just don't have the data or concrete evidence that we are having this sort of hidden extreme shorting activity against the stock, as hedge funds are secretly trying to take down the company. With the ETF, for example, some have argued that this large short interest is simply related to the process of generating ETF units, which I won't spend a whole lot of time diving into here because it could have its own video, but I'll leave a link to an article explaining more about that process. And even that high short interest value for the ETF has seen much higher levels in the past without triggering a short squeeze. So it's not really a clear-cut or black and white situation. And again, while there is that narrative, the hedge funds are trying to hide their short interest to convince retail investors that there's no short squeeze potential. It does seem more likely that the short interest we do see is probably more reflective of the trends of this hidden activity that's not necessarily reported, meaning that as we see this short interest decline, it's likely reflective of the other short interest that we aren't able to see. So that's the first thing worth highlighting, which is that while short interest is, again, a very crude number, it is seemingly a lot less than was with the initial rally. The second idea worth tackling is this idea that short sellers won't be able to cover their shorts, which is going to push the stock price much, much higher as retail investors take shares out of the market. With the general idea being that through things like direct registration, whereby a shareholder puts their shares in their own name rather than doing so through their broker, which, to oversimplify, would prevent the broker from using the shares behind the scenes while it's in your account to help fulfill market orders. That's going to take a lot of available shares out of the market for potential buyers. So as buyers clamor to find shares to buy to cover their shorts and whatnot, that's going to push the stock price higher and higher. And that certainly could be a factor. Again, while short interest is lower, we do see a good chunk of the company's shares being directly registered in investors' names, with 25% of the float having this direct registration. There, however, it is worth highlighting that this percentage hasn't changed over the past year. And secondly, it's worth considering the possibility that the company can and even might likely issue more shares, especially given that the stock has risen so highly in price. It's what they actually did in their initial rally to pay down their debt, with the company increasing their share count by roughly 18%. And if the company continues to fundamentally struggle to generate positive cash flow, they might look to take advantage of their higher stock price and raise more investor funds to keep the lights on. So yes, technically, if you were able to, say, corner the market and restrict supply, that could have an influence, but supply isn't inherently constrained given this one factor. Also worth highlighting here that institutional ownership for the stock is roughly 30% of the overall float. I mean that there's still a lot of larger sort of corporate investors holding this company stock. Thirdly, a point that also came out of that SEC report mentioned earlier is that a lot of the 2021 rally that people believed to be a GameStop short squeeze wasn't really the result of short sellers covering their position. There's this really great chart from the report that shows just how much normal long investing outweighed the short selling covering rather of this position during the initial rally. So while short squeezes did contribute to some of the price momentum, the historic jump really during the most volatile period wasn't retail investors forcing short sellers to cover their shorts. It was mostly just their own buying activity, or rather just buying activity as a whole, because another important point to highlight here is that a big portion of this buying activity, especially in the last week, was institutional, which includes hedge funds. Meaning that, yes, while retail investors were a big force behind the initial rally, a lot of it was eventually taken over by institutional traders, which is why we saw some articles highlighting just how profitable some of the funds were with the initial rally. Now, if you're someone who only cares about screwing over the short selling hedge funds, again, all the power to you. I'm not here to make a stance on that. And it is your money. You're welcome to do whatever you like with it. But it's just worth highlighting. This isn't screwing over all the hedge funds out there. Some will lose and some will win, much like pretty much any stock movement there is. It's also worth addressing here the idea that Monday and Tuesday's surge could be tied to a gamma squeeze, which, to oversimplify, is when investors buying up call options itself pushes the underlying stock's price higher. That could again be the case here, especially given how many call options found themselves in the money this week. But again, the SEC report on the last GameStop rally found that there wasn't much evidence of a gamma squeeze then. So it's not really something we can assume is inherently the case this time around. Really, only time will tell. And finally, the last point I want to touch on is more encompassing of really all the speculative theories you can come across with these stocks, because whether you look on certain subreddits or just on social media as a whole, you can come across different options trading activity analysis or dark pool analysis and things of that sort that will argue why the stock is about to take off, why institutional investors are going to be forced, no matter how hard they kick and cry, to buy this position. And it's just worth highlighting how speculative these theories really are, regardless of how confident the poster might be. As I've hopefully highlighted, market activity can at times get very complicated. And while you can see these elaborate theories sort of painted around that, historically, when it comes to meme stocks specifically, they haven't often played out. Take Bed Bath & Beyond, for example. You might remember that we covered this stock a while ago when the company had announced that Ryan Cohen, currently the CEO of GameStop and sort of a messiah for the most extreme GameStop supporters, when he had sold his stake in Bed Bath & Beyond, there were all these theories that people stood behind to argue that this was actually a move to buy a sub-business of Bed Bath & Beyond, that Ryan Cohen's profits from selling the shares would actually go back to investors somehow, and people would make off with a killing. The company ended up going bankrupt and investors lost everything. And even then, investors were under this belief that somehow their shares would come back from this bankruptcy and they would make a bunch of money holding on. Even with AMC, which is still down over 80% over the past year and more so from its peak in 2021, even with this surge in its recent price, I recently was able to talk to Trey's Trades, who was a sort of poster boy for that movement, who was really honest in admitting that he didn't fully understand how markets worked at the time and regretted a lot of stuff that he posted about how this stock was about to surge in value. And I say this not to highlight that every speculative theory is going to eventually be wrong. There could obviously be an exception where something ends up being true. You could argue that Keith Gill's initial thesis might have been more speculative at the time, but did end up making him a bunch of money. But it is to highlight that while someone might present themselves as overly confident about where a stock is going, and that might convince you to invest into a position, you have to recognize how rare those events are and how risky these types of strategies can be. Not only are there conflicts of interest, given that these people stand to benefit if you buy into the same position, but they are subject to the same biases and euphoria that the rest of us are. And that can lead to a lot of problems with their messaging. So maybe we do see GameStop rally and even reach a new all-time high. This is not the type of investing I specialize in or focus on with my own career. But it is just to highlight all the examples of times we've seen this sort of full-chested claim that these stocks are going to skyrocket fall flat and lose people a bunch of money. And you have to be aware of that when you go and play positions like this. And only time will tell what's actually happening with the markets, whether the stock continues to go up or down. But at least now you'll have more context about the stock movement, how it compares to the past rally we saw, and what that past event can tell us about this event now. And a lot of this assumes that people are really considering, again, the more intricate theories here. Hopefully it goes without saying that buying a stock based off a bunch of memes that were posted on X, a bit of a gamble. And just to highlight that again. Anyway, thank you for watching. I hope you found this video helpful. If you did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts down below, even if you disagree with me. Maybe you're an avid GameStop supporter. Happy to hear your thesis or your arguments down below and welcome any debate around that. Just really, again, looking to highlight the cautious side to sort of offset more of the euphoric stuff out there, not to really argue that people should sell or buy or short or anything like that. Just looking to bring more information to the table. Anyway, yeah, thanks for joining. And as always, be safe out there.